Hello, everyone. This is the latest edition of The Officials and live from Beijing. My colleagues are in London joining this session, and we are going to share our latest views on what has happened and is likely to happen over the next days and weeks. So, what we have seen since the last edition of The Officials is that indeed Israel decided to attack as in a long promise counter to the previous counter to the previous counter. I am losing track about who is responding to everyone. And it sounds to me almost like a kid's game. Daddy, somebody pinched me, and that's why I beat him. And or all uncles that are angry with each other. It's time to stop, but never mind, it makes for a very interesting oil market. So the Israelis attack, and they said that was done with a lot of precision, so much precision that apparently didn't cause a lot of damage. And in the following days, there was a lot about the damage being done, but no pictures shown, no evidence of a lot of damage. So what it seems to me is that the attack was designed to essentially say we are doing something. And the market naturally looks, analyzes, and sees through the nonsense and says, nothing much is happening here. It's time to sell, as we say in the officials, time to sell the sucker down. And they sold it down to 71 plus from 76 plus, where it was prior to the attack. It was a ferocious sell off in a matter of hours, and the market looked very weak. And we continue to hold a view that the market is need to go into the upper 60s in the next. But as we all know, after a sell off, there is a need naturally to cover back those positions that people sell in the way down. And at the moment, we are in that situation where there has been covering, a little bit of talk by OPEC that may delay the expected increase, even though even this past week they have said that they would increase. A lot of mixed messaging, but it's clear that OPEC needs more money, like any other producer would. I had the opportunity of being in Dubai a few days ago and also in Abu Dhabi. Got together with a lot of friends, and they remain of point of view that yes, we need to do what we need to do, and maybe some countries in the region are producing more than they should, but they're doing it quietly, right? The sense is nobody wants to really poke at the real numbers of what the overproduction is, because in a way we're all our neighbors and we're not supposed to make fun of anyone. And from there, I am now in Beijing. And in Beijing, what I wanted to share with you is what is the feeling here. We're very interested in China. Is China really that slow? That's a very big question. And I think the Chinese government is giving the answers by pulling out all the stops into what they're going to do to pump up the economy. And this economy, in my opinion, needs some help. I haven't been in Beijing for a number of years, since before COVID. And if I, like I did in Shanghai, if I compare the past with the present, maybe not much has changed. It feels clear. It's a Thursday night, and the streets are not vibrant. I mean, there are streets, but not as I remember. So something is definitely going on with the economy. And we had the great opportunity to meet with many people today, including some officials that are in charge of doing market analysis and things like that. And the overall sentiment that they gave us was that the market is not doing well, that yes, as you would suspect, gasoline demand is contracting, and that yes, even diesel demand had contracted. They were hopeful that the measures by President Xi would restore some normalcy to the construction market, and that maybe in 2025 there would be a rise in consumption. Regardless, these officials expect demand in China to peak between now and 2027. So the Chinese story in oil is over. And they announced as well that they were shutting down a refinery in the north because another refinery is coming up in Yulong, and that essentially they're balancing the market. One goes out and one comes in, but there is essentially no growth. And that's not a good story for China, because the story for China has always been about growth. They're also keenly aware that they have been the engine propelling the oil market. And we asked them, so how do you feel? Because you get a lot of visitors, you have many consultants, you hear OPEC, Energy Aspects, FEG, all of them who have numbers showing close to 2 million barrels a day of growth. And how about your numbers? And their numbers are nowhere near there. They are maybe at the most 1 million barrels a day, if not less. I explained to them that in our view, is no more than 600,000 barrels a day. And I asked them, you get all this range from 600 to 2.1. Who do you think is right? And one of them said, we think we are right, of course. And we think that the OPEC numbers are wrong, because we know that China is not growing, that it has been having these major issues. So we obviously like growth. We hope that President Xi's measures change the direction of the market. But as of now, we are calling for a peak in gasoline demand, definitely, with some hopes that maybe diesel goes up. We will see what happens, but we remain on the line of travel of a market that will be in the 60s soon. And we're daring enough to tell the Chinese officials that probably we would see a market with a 6 on front of it before the end of the year. With that in mind, I would like to open the floor to Ed. What do you see happening in the Middle East, Ed?
Well, as you mentioned, really, the retaliation from Israel, if it can be called a retaliation in this ever tit for tat response that we keep getting between Iran and Israel, came in on Friday night, Saturday morning, and really underwhelmed what the market expected. There was no attack on nuclear or oil infrastructure. There was just seemingly a few missile strikes or airstrikes against some military infrastructure, military sites. So on the morning, as you said, we opened way down. It was something like over $3 down at the Asian Open on Monday morning. And now even today, we've heard that there are going to be some more talks between Israel, the US, and Lebanon. The Lebanese government looking to get a temporary ceasefire in Lebanon. I think 20 days was the kind of number that was floated according to what I saw. But then we've heard a lot of rumors about peace talks over the last year, even between Israel and Hamas and Israel and Hezbollah, and none of them have really come to anything. So I'm not convinced that this round will have any different effect. But then the US at the moment is probably putting quite a bit of pressure on Israel with the upcoming election next Tuesday, because for the Democrats it's a really tight race. Kamala Harris is polling slightly above Donald Trump, but the betting markets have her trailing him by a significant amount. In terms of the polls, there's only a point or 1.5 points between the two, but the betting markets are giving Trump something like a 65% chance of winning. So really there's that disconnection between the two, and it makes it very difficult to predict which way it's going to go. The key battleground states between the swing states of like Pennsylvania, Arizona, Georgia, they're all looking pretty tight. So any kind of small change would definitely swing it one way or the other. And I think therefore the Democrats are probably putting quite a lot of pressure on their Israeli allies not to do anything rash in the next week or so, because that would really harm their chances.
Let me interject there. Let me interject there a little bit. Obviously, I talk to a lot of people. Some are Democrats, some are Republicans. And needless to say, there is a tendency for the people in the oil business to be more Republican and therefore more pro Trump. At the same time, I talk to another set of people that perhaps are more like me in the fact that we don't identify solidly with one side or the other, but we love peace very much. So a bunch of peaceniks. And the peaceniks are also with Trump. They think that Trump is more likely to push all these nations and groups that are fighting towards finding a resolution, right? And that's what makes the next few days very interesting. And we'll keep you informed about who we think also is. And we put a lot of credence on the betting markets because that's what sorts it out, right? If you put your money where you believe is, it shows up. Uh, but anyway, enough of that because nobody knows. What is very clear is that the line of travel, the indications of the macroeconomic environment are negative. And we have two people that love banking things, are experts matter. One has a lot of experience. So I wanted to hand over the floor to Mr. Harry to share his views and prognostications. Harry?
Well, I think, Jorge, thank you. And hopefully it's not too late in Beijing. I think Will and I have been talking quite a bit about interest rates and the direction of interest rates, and in particular, following up a little bit on these US elections, if whether or not there is an inflationary Trump trade that's going on. As you may have seen in terms of the headlines and the financial news, family offices, prominent bond traders are saying that they're essentially, going to sell their bonds because of Trump's economic programs, and been pointing to higher yields as a consequence of those programs. And we tend to look at that differently because we decompose the nominal yield into its components, so inflation expectations and the real rate of interest. And so, as Will and I have been examining market-based measures of inflation expectations, these could be U.S. inflation swaps, 5-year break-evens, or even just looking at one of the measures the Fed looks at, which is the five-year break-even. The inflation expectations haven't been moving, and what has been moving is actually the real rate of interest. And we think that's pretty symptomatic of the fact that we have U.S. economic exceptionalism, in the sense that the data has been much better than expected in the U.S., and that the U.S. is, on a relative basis, doing obviously better than Europe and struggling China. So under those conditions and labor markets that are doing well, there's no rush for the Fed, right, Will, to do anything rash. They are going to be incrementally cutting rates, and we'll probably see a rate cut in the November FOMC, but not anything brazen, sort of easy as she goes. Would you agree that the data and the general Fed reaction function in this respect is probably pointing to something gradual?
Yeah, for sure. I think, like you said, the US seems to be outperforming other advanced economies by a pretty significant margin. To have a downside surprise GDP come in at 2.8% is looking pretty good. Payrolls, again, they've been pretty strong. Continued claims looking better than a few weeks ago. And ADP data, although it's messy, came out far above expectations, at almost double what the market was expecting. So if we get a repeat of that come Friday, in the payroll print, then definitely the Fed will be in a position where they might not need to cut so aggressively.
We also got inflation data, the Fed's preferred measures today, right?
Exactly. And PCE today came in at 2.1%. So, basically touching their target of 2%. And that's going to be a big relief for Powell. PCE data has started to become kind of secondary to the payrolls data and what's kind of the Fed is following, but still, nonetheless, that descent towards 2% will be reassuring. How much further this sell-off in yields go, in treasuries go, sorry, because that in and of itself is restrictive.
Yeah, I tend to, again, like obviously there are people projecting how much more extra debt is going to be put on by one or the other candidates. My view is that these very savvy bond traders are essentially trading event risk. So when they go out there and sort of use that the projections by consultancy A or B on how much extra debt is coming, at the end of the day, this is all about portfolio hedging. So if you think about it, you go, I dump a lot of bonds. There's a lot of sell flow going into the market that needs to be absorbed. As a result, yields do have to move higher. But why did they do that? The event risk of Trump becoming president is very bullish equity markets, right?
Yep.
And so maybe corporate tax rates get cut again, or at least they don't get increased. And so shifting your portfolio a little bit away from bonds and getting prepared to go into equities under that event risk of Trump winning, at least according to the betting markets, well, that changes quite a bit the dynamic of the market in terms of issuance, absorption, sellers, and how much you need to be rewarded in order to hold those bonds, thus a higher yield in the end. But it doesn't matter. I mean, the markets determine the yields that are on further dated tenors. The Fed has control of the front end of the curve, as they say, and I guess one could argue maybe that the further they bring down rates, the higher up yields are going to go at the back end, and for those who are trading bonds, steepeners would be the way to go.
Yeah, and definitely watch out for gold as well, because I think that's been driving a lot of that portfolio rotation as that's outperformed significantly.
But I wanted to say that the market is not just the US or just China, it's everything, everyone. And the US is doing better than the rest. And this is why it's the largest economy in the world. China is definitely slowing down. So there are some areas of the world, Germany and Japan, that are very important, and we cannot forget about them. So, Harry and Will, let's start with Harry. What are your thoughts of the impact of their debt problems and their economic problems on oil? What's going to happen?
Well, Jorge, you raise obviously the broader issue, economic interdependence, right? And especially when you start looking in Southeast Asia, there's a lot of deeply integrated ties between China and neighboring economies. You were recently in Vietnam. You've described at length a lot of the commerce going on and the increasing commerce between the two countries. But that's also true of many other countries in the Pacific Rim. At the same time, Japan is a large export market for China. And so when Japan is not doing so well, you have negative feedbacks, of course, going back to China. So there's obviously a lot of secondary effects, as economists like to call it, when the big giants of the world economy catch a cold, or if not worse. Now, I would say that these economic interdependencies mean that if you do have a country like the US that is doing better, people tend to look at that as somewhat of a hedge, a prop, so that the world economy does not completely decelerate in its rate of growth. But on the other hand, we do have many countries, and I'd even look at a country like India, that's obviously externally oriented in its economy, having to also deal with partners that are struggling. So in terms of the general aspect of how we look at the macroeconomic realities, yes, we tend to focus on the big guys, but at the end of the day, we have to note that there are additive effects of all the people that are interdependent to these economies that could lay on that extra bit of bearishness. So when we're talking a little bit earlier about oil prices having to go down, right now, let's say the geopolitical balloon has been pierced, a lot of the air has come out. And so we're facing these fundamentals. They're not looking very good. And as a result, it's likely whatever OPEC does or decides not to do, as you may as you rightly put it, we're looking at sub 70 as a distinct possibility. And we tend to take these shortcuts, I guess, by looking at US, China. But you're absolutely right in saying that, it's not without consequence for the rest of the world, and especially those economies that are directly tied to them, because they also are additive to how people project oil demand in the current context, right?
Okay. I will close with the following, maybe to give you some trading recommendations or advice.
Can I ask you a question first? It's geopolitical. What do you make of North Korean troops joining Russian troops in Ukraine?
Well, it is something that can be used as a trigger to further action in the area. If I know anything about international relations, the US will keep the Korean troops only within Kursk, and they will make sure that they don't penetrate Ukraine. And frankly, the Russians are a little overstretched in the manner that the Ukrainians are overstretched. So they're all helping each other, and this means more people are dying. And I really hope with the change in presidency that it doesn't happen any further. But going back to the oil issue, we just noticed it was a topic of discussion this morning that Anduran was going in and going long again. So for those of you who like to follow big names, there you go. The man is buying. For those of you who are contrarian, there it goes. The man is buying. So make a wise decision, and see you next week, the officials.